Welcome back to the Deep Dive, where we try to make sense of the latest research so you can use it. If you've been watching the markets at all, we're deep in this AI gold rush.
No, absolutely. It's everywhere. Every big tech company throwing just, billions into building out the hardware, the infrastructure. The feeling is it's limitless.
Right, the optimism is just off the charts. We see these headlines, massive investments, valuations soaring, all based on what AI might do someday.
It really is the defining economic story right now. You see these huge commitments, 100 billion here, maybe more there. It's all future potential driving things.
But what if that gold rush isn't quite the endless profit engine everyone thinks? What if there's a kind of financial trap hidden in the numbers?
That's exactly what we need to dig into today. We're looking at a pretty serious warning that just came out.
Yeah, we're diving into the Bain & Company's 6th annual Global Technology Report. It just dropped a few days ago, September 23rd, 2025.
And it throws some serious cold water on all that market excitement, a real counter-narrative.
Okay, let's unpack this and see where the risks and maybe the actual profits lie. So our mission today really is to get a handle on this huge financial imbalance Bain is warning about. It's like the biggest risk they see.
Yeah, and we need to figure out why the market seems to be, well, shrugging it off for now. The great disconnect, as they call it.
Right. And most importantly for you listening,
Yeah.
we want to lay out the kind of two-stage strategy you might need to think about for navigating this whole AI boom successfully.
So let's start with the core finding, because it's a really big number. Bain is projecting this massive financial hole for the AI industry.
How big are we talking?
They're forecasting an $800 billion annual deficit by 2030.
$800 billion annually. That doesn't sound like a temporary blip. That sounds, well, enormous.
It is, and it seems completely at odds with, every company saying AI is the path to trillions.
Exactly. How do they get to a number like that?
Well, it really boils down to timing and sort of the basic math and physics of it all. To actually run all the AI everyone expects by 2030, power the models, deliver the services, the industry supporting it, chips, data centers, cooling, power, they need to be bringing in about $2 trillion a year in revenue.
$2 trillion just to cover the costs of building and running the infrastructure.
Exactly, just to break even on that side. But Bain's warning is that based on how fast companies are actually turning AI into, real paid services that people are using at scale.
Right, the actual commercialization speed.
Yeah. That revenue is only likely to hit around $1.2 trillion. So the difference, that's your $800 billion annual funding gap, your shortfall.
Okay, but hang on. Aren't projections like that usually based on how fast things were adopted in the past? Couldn't generative AI just be moving way faster? Maybe the revenues will show up quicker than Bain thinks.
That's a fair question. And that's sort of the tension here. Adoption is fast, no doubt. But the problem, the report argues, is that the costs, especially the CapEx, the money you spend building the actual physical stuff, the data centers, getting the chips.
Yeah, the capital expenditure.
That's growing exponentially, just shooting straight up. But most companies, Bain says, are still stuck in what they call experimentation mode.
Experimentation mode, meaning?
Meaning they're spending a ton based on AI's potential, based on the hype, but they haven't really scaled up the actual services that bring in steady, predictable profits yet.
I see. So it's not that AI won't make money eventually. The danger is this big timing mismatch. Spending skyrockets now, but the revenue kind of trickles in later.
You got it.
Yeah.
It's like, imagine spending millions, maybe billions, building this huge state-of-the-art factory for some amazing new gadget.
Okay.
But right now, you're only using it to make a few prototypes, just testing things out. You've already paid for the giant factory, the massive cost is sunk, but you haven't started selling the actual gadgets at scale to pay the bills.
That makes sense. That's the $800 billion trap right there.
Right.
The bill for the factory comes due before the product sales ramp up.
Precisely.
Now, here's where it gets really interesting. This warning from Bain, it's out there. People know about it. Yet the market, you see news about maybe NVIDIA and OpenAI cooking up a $100 billion plan or something.
Right, these huge numbers keep coming.
And the market just keeps climbing. So why the paradox? If there's this giant financial pothole ahead, why isn't Wall Street hitting the brakes?
That great disconnect is, I think, the absolute key to understanding what's happening right now. The market isn't really focused on phase 2 yet. Who actually makes money from the final AI services.
Okay.
It's laser focused on phase 1, the definite stuff happening right now. which is building out all the necessary infrastructure.
They're playing the classic pick and shovel game.
Exactly. It's the oldest play in the book for a gold rush. Don't bet on the prospectors finding gold that's uncertain. Bet on the companies selling the picks, the shovels, the wheelbarrows.
So the chip makers, the data center companies, the power suppliers.
Yeah, all of them. They make money now from the effort of building everything out, whether or not the final AI applications that run on that infrastructure actually turn out to be profitable down the road. They get paid for the build.
But, okay, even in this infrastructure phase, this phase one spending spree, our sources point to something specific to watch, a potential early warning sign.
Yes, and it's subtle but important. It's the demand slowdown warning that came from ASMI. They're a semiconductor equipment maker.
So they make the machines.
And they make the chips, exactly. These incredibly complex, expensive machines. So if demand for their equipment starts to drop, it's a very early signal that the pace of investment in new chip factories and therefore data centers might be starting to slow down. It's like the first tiny crack appearing in that phase one foundation.
Wow, okay. So if the company making the machine to build the machine sees a slowdown, that suggests the big buyers, the hyperscalers, might be tapping the brakes already. That's predicting a slowdown, not just reacting to one. Super early signal.
That's the potential insight, yeah. It suggests that even this picks and shovels market might not be infinite. There are limits.
And yet, phase one is still roaring ahead for now. We're still talking, what, an estimated $3 trillion in data center investment just over the next 4 years or so?
That's the number floating around, yes. A staggering amount of capital.
Which leads to the obvious question. Who's actually funding all this? Where is $3 trillion coming from? It can't all be traditional bank loans or selling stock, can it? The scale seems too big.
No, not entirely. And this is where we get to what you might call the unseen kinetic energy behind this boom. It's private credit.
Private credit. Now, this isn't just like a slightly different kind of bank loan, right? This is a whole other system.
It really is. Think of it as the sort of ghost in the financial machine. It's lending that happens outside the regular banking system. It's more flexible, less regulated, often handled by huge private equity funds, sovereign wealth funds, big institutional investors.
Okay.
It's like a specialized fast-track loan market. And the key thing is it can move money much faster than traditional banks, which are tied up with more regulation.
Right. They can approve and fund these massive data center projects way quicker.
Exactly. That speed and flexibility is crucial. It's what's really enabling this incredibly rapid build-out. A project that might take months to finance through a bank could potentially get funded in weeks through private credit channels.
So when we talk about $3 trillion for data centers, which is like, what, the entire annual GDP of a country like the UK or France being spent on these buildings in just 4 years?
Yeah, it's that kind of scale.
Understanding that a lot of it is funded by this fast-moving private capital helps explain how it's even possible.
It does. It's the fuel for the phase one fire.
Okay, so putting this all together, this Bain report, the $800 billion gap, the phase one focus, the private credit engine, it really means we need a kind of two-stage approach to thinking about investment here, doesn't it?
That's the core takeaway, I think. Phase one is about concentrating on the infrastructure, focusing on the companies that are the definite beneficiaries of this massive build-out right now, the ones getting paid regardless of whether the ultimate AI services succeed or fail 3 years down the line.
So give us some examples. Who are the key players in phase one that the sources highlight?
Well, you obviously start with chips and semiconductors. NVIDIA is the name everyone knows. They're powering so much of this.
Right, the engine room.
Then you need the actual buildings.
Yeah.
So data center REITs. A REIT is just a real estate investment trust, basically. Companies that own and operate the physical data center buildings. They're like landlords for computers.
Collecting rent.
Collecting rent. Equinix, Digital Realty, those are the big, well-known names there. They make money as long as the space is needed.
And these places use a ton of electricity and get incredibly hot.
Insanely hot. Which means power is critical. Companies that can supply reliable, large-scale power are essential. Think utilities focus on renewables, maybe like NextEra Energy. And then there's the cooling systems. You can't forget that.
Right, keeping the chips from melting.
Literally. So companies like Vertiv or Eaton that specialize in sophisticated cooling solutions for data centers, they're solving a fundamental physical problem. They're definite phase one players.
Okay, that's phase one. Focus on the infrastructure, the picks and shovels. But then what? What happens when we hit that transition point, when the market starts worrying about that $800 billion gap for real?
That's phase two, verifying monetization, the future, as you put it. This is when the music changes. The market stops rewarding just potential and starts demanding actual proof of profit.
The focus shifts from hope to hard numbers.
Exactly. The key strategy then becomes looking very closely at the profitability model of the AI software and service companies themselves. Can they actually make money at scale? Is the revenue predictable? Is it growing?
This is when we find out who's really built a sustainable business.
Yes. This will be the true sifting of the wheat from the chaff. Companies that have just been riding the hype wave but can't show real earnings, they could face a pretty brutal correction.
So the crucial question for anyone watching this space is, how do we know when that shift is happening? When does phase 1 peak and phase 2 scrutiny begin? Are there specific signals we should be tracking?
There is one financial metric that Bain and others point to as probably the single most important signal to watch.
Okay, what is it?
It's the quarterly capital expenditure plans, the CapEx forecasts from the big cloud service providers. Amazon AWS, Microsoft Azure, Google Cloud.
Because they're the biggest customers buying all the chips in data center space.
Yeah.
They're driving the phase 1 spending.
Precisely. They are the engine of the build-out. So you watch their quarterly reports very closely. If their planned CapEx spending for the next quarter or the next year comes in lower than analysts expect, or if they actually revise their future spending plans downward compared to what they said before, that's probably the strongest signal you'll get that phase 1, the big infrastructure spending party, is starting to wind down.
Got it. Watch the cloud giants' CapEx plans like a hawk. That's the key financial indicator.
That's the canary in the financial coal mine for the phase 1 peak.
Okay. But looking even further ahead, beyond the financial signals, what's the ultimate physical limit here? What could eventually choke off even the winners?
Well, the sources are pretty clear on this. The ultimate physical bottleneck for AI, long term. It's probably not the chip technology itself. We always find ways to make those faster or more efficient.
Right.
The real constraint is power, just raw electricity.
Electricity. Seems so basic, but...
But think about the scale. These AI data centers consume staggering amounts of power, 247. You can design the best AI model, have the fastest chips, build the biggest data center.
Right.
But if you can't get enough reliable, affordable, and increasingly clean electricity to run it, it's useless.
So the real long-term competition might not just be about algorithms, but about securing massive power contracts.
It could very well be, which leads to a really interesting long-term thought. The ultimate winners in the AI race might be the entities, companies, maybe even countries that can secure and deliver huge amounts of stable, carbon-free power.
We're talking next-generation stuff here.
Potentially. Things like small modular reactors, SMRs, maybe even fusion power down the line if that pans out, advanced geothermal, massive grid-scale battery storage systems. Companies that master those technologies might actually hold the keys to the AI kingdom in the long run.
Fascinating. It reframes the whole challenge.
It really does.
So what does this all mean for you listening to this? The big takeaway from the Bain report isn't necessarily panic, sell everything AI.
No, definitely not panic.
It's more a call for, well, strategic thinking. Understanding the timeline. There's a short to medium term reality, phase 1, the infrastructure build, and a longer term challenge, phase 2, proving profitability and securing power.
Right. It's about shifting your view from just buying into the general AI hype to strategically focusing on these two different phases and knowing what signals mark the transition between them.
It means looking beyond the headlines to the underlying economics and eventually the physics.
And that leaves us with maybe one final provocative thought to chew on. We talk constantly about processing power, petaflops, training data. But if the real ultimate constraint is just getting enough clean, stable electrons flowing, does the future of investing in AI start to look less like a pure tech play and maybe, just maybe, a bit more like a high-stakes, next-generation utility and energy infrastructure play?
That is something to think about. Who controls the power controls the AI future.
Potentially. It's a long way out, but worth considering.
Definitely food for thought. You can find links to explore the source material further in our show notes. Thanks for joining us for the deep dive.